All right. Good morning, everybody. Um, Little housekeeping. I'm going to try to start doing this all next year. Someone challenged me to do this, so yeah, why not? The replays are on my YouTube. The goal next year is to actually start pushing that YouTube. So the charts that I use in the morning briefing, I'll be updating the links in that YouTube description to cover all of the charts and the indicators that I use. Go over there, like it, subscribe, all that stuff that you guys always hear about. But let's get that channel up and running. Got to have goals, right? So if you want to have the charts, that's where you'll get it. I'll probably add the trading view charts too, because I know not everybody's a fan of Thinkorswim. All right, so we got that out of the way. Let's move on. We're past the cut finally. And it was not so hawkish after all. That's what everybody was anticipating. It wasn't really that we were going to get a cut or not get a cut. It was the guidance that we were all looking for on the other side of it. And now a lot of focus is going into um, what the Fed is going to do with the balance sheet. So we also now want to keep track of the next QRA event. That's going to be front and center, and also the government shutdown or potential government shutdown. That's on the way. One thing at a time, though. We're past FOMC. We got some impact from Oracle yesterday. And so we're seeing a little bit of a rethink on our current spend in the AI space. Japan's up more than 0.75%, while the NASDAQ is down around a half. Everything was worse than this, and it's already starting to turn back again. Small caps doing really good at 0.25%. So it's quite a discrepancy. In the last 2 months, when we've seen small caps outperforming in the overnight, that usually ends once we get into the 9:30 market open. Then we see small caps take a back seat and the NASDAQ kind of rally to the front. Keep your eye on the European close today. So we are going to get job numbers. We're a little off here between 191 and 223. We'll see how that comes in, how close they are to what they had expected. And we have the 30-year bond today. This one's kind of a big deal. I know it says 2 o'clock. Ignore that. It's 1 o'clock. 11:30 and 1 o'clock is going to be the auctions. It doesn't show it as a high impact, but these bond auctions, I've focused on them for years, even when it seemed like I was the only one doing it. A lot of times it's just nothing, right? The clock rolls by and nothing happens and just nothing comes out of it. But every once in a while, these bonds throw a curveball. So keep your eye on the clock, especially when it's the 30-year. Keep in mind that everything we're seeing off of this Oracle earnings, this is all sentiment driven, right? They're reading into everything else from this one earnings event, and they're already a little skittish, kind of shell shocked. So sentiment can change in the blink of an eye and go from being a little skittish to full blown panic, or back to exuberance and buying again. Nothing is broken. right? There's no actual physical event that has changed everything. Just one earnings and sentiment and attitude has changed. It would be different, right? If it was an actual thing, like when that ship got stuck in the canal, or when Boeing had airplanes falling out of the sky, killing entire families of people. Those were things you couldn't take back. This is just sentiment. This kind of goes into what I was talking about with the bonds. The Fed says it will start buying treasury bills to manage market liquidity. They're going to refill. All right, the president's got some events today. Briefing at 1 o'clock. Yeah, at 1 o'clock is going to really be it. So we could get some out of that. Otherwise, I wouldn't expect too much unless they do some late day press releases or something. All right, we're looking at Mentor Q and the CTA charts. One day, we don't have enough data yet. We need to see how this plays out for the week, but you can see the turn. Just because it's pointed to the downside, the week needs to finish up, right? It could be just a little tiny pullback and then a continued move to the upside. We don't know yet, but it is a change from what we had earlier in the week. So it's worth pointing out. And that move up in silver, I know it's probably hard to see on the live stream, but it pulled back in a bit of a consolidation after that breakout. Silver's just out of control. One of the takeaways from the Fed meeting yesterday was that these normalization cuts, which is what the arguments had been for the cuts so far, they had run up the rates trying to get inflation under control. And once they had thought things were fine, they started to cut back just to get back towards, quote, the neutral rate, which is mythical and hypothetical, right? It's like this imaginary beast, like a unicorn. So they don't know where neutral is. They're just kind of trying to get back towards this imaginary line in the sand. They said yesterday that they think they are back to that imaginary line in the sand and that they will not provide any more cuts for normalization. So the last three cuts were just to get us back to, quote, neutral. If we are going to see any cuts now, it will be because there's actually something wrong. Now, that's going to change the dynamics in a lot of things because now, bad news, good news, and good news is bad news. If the market wants another cut, things have to be bad enough that the Fed sees a cut as a viable option. So we have a Fed put now, right? We can anticipate that if things get really bad, the Fed's going to step in and cut because things are really bad. So, plunge protection team, market save a hoe, however you want to phrase that. That is new. That is the new dynamic we are in, that we'll be looking for rate cuts only if things get bad enough to warrant a rate cut. We still don't have a change in the call wall, put wall. As I mentioned earlier in the week, it's likely that we will not see a change until after OPEX, or as we get into OPEX, because they'll roll, you know, as we get into the OPEX. OPEX, if you're new, options expiration, it's the third Friday of every month. You can count on that and anticipate it. So we're still at the volatility trigger. We're dancing above and below the 10-day moving average, bounced off the 20 in the overnight last night, and we're hitting the 3 period this morning. So if we come out to the daily, take a look at what we've had set up out there. We're still sitting in this tightly wound range. We got the moving averages spread out really nice like a fork pattern. And we tested that 20 today. So now we need to see the response off of that. If everything is good, then that's a really nice reset like we had back here, where we broke up through the 20, came back and checked old resistance as new support, and then pushed on. Broke through the 20, been stabilizing after this really fast run. We've had a correction for, what, 2 weeks? We're going to call this a correction since price can correct 2 ways. It can pull back. That's one way to correct. Or we can go sideways. This is called a correction in time rather than a correction in price. So we got a little ahead of ourselves. We ran too far, too fast. We've been correcting, giving the market time to heal, let the moving averages caught up since we outran them a little bit. Now everything is caught up. We've corrected, we've stabilized, all the other good words you want to add to that. Now the next thing can happen. If we're going to remain bullish, then this tag is, say, the raid from the draw, and we should be ready to break the other side. If we're bearish, then we're going to, this is just the first tap on something like a 1, 2, 3 fail play. And we'll cut this 50 and work our way down to the halfback and then on down to the lows. The halfback is 66.92 cog line. Can't make that up even if you wanted to. The 10 period is 68.50. We've been running 50s for a while now. If we close below 68.50, that puts 67.50 on deck as a target. We do have the run up. We're looking to see the pullback. If this is going to be it, then fine, that's it. Otherwise, we'd still have 786 as a valid pullback, which means we could break the 20 just to come down and get into that 786 for the next leg up. It doesn't have to do that, right? This pullback would just be what we expect at a price as price moves up, right? But the digestion that we've had kind of counts for that same thing. Correction in time versus correction in price. We're inside of a really big bar. It doesn't seem really big from this perspective, but it's around 70 points, and that's big enough. The average ADR right now is what, like 86 points? So that's just a little bit more than the average daily range. We'll see what the ADR is in a minute, but I'm thinking it's pretty close to that. So when we're trapped inside of a really big bar, that big bar becomes the boss. GTFO, we got to get out of that box to get anything else done. And the break of that bar should be the play. Now we had yesterday's 111 and 1236, which is that reversal. I wasn't trading in the overnight, so I didn't get it. But we've already done it. and we're back above the midpoint. Getting back through the mid is a really big deal, but it's all in the pre-market, and that isn't as good as doing it in the regular trading session. So we got to hold above that half once the market opens and keep it. The fact that we're through all of the major moving averages, we came back through the 20, the 10, the 3. There's no moving averages in front of us at this point. We can drive to the upside with the only thing to fight against is this liquidity range that we've been fighting for a while now, 69.11 cog line, and all of these attempts to get through that level. It actually runs all the way back here. So it's a significant range to get through. We have had a really hard time trying to get through that zone. We'll see if we've absorbed enough liquidity at this point we can make it through. So you can see my failed flag play. I love this. Let's just clean everything up here for a moment. Typical flag should come down, put in the flag, and then continue the move to the downside. That's a regular bear flag setup. We call it the failed flag play when it stays too long in that flag part, not the pull. The pull is fine, but down in this part, stays too long, maintains underneath or around that 786 and 100 area, and then finally begins to move back the other way. You can find this setup on a 30-minute and an hourly for a really good short-term swing trade, say a 2 or 3 day trade in the futures, or in the SPY if you want to go that route. But this setup's a really good setup. A lot of times the pull, if you're looking at it on the 30-minute or 15-minute, it can last 2 or 3 days, right? It's a 2 or 3 day dive to the downside, and then like a half a day of the flag, and then we get the reversal. So it's the same setup. It would just be over a duration of days. And of course, then you get the run back on the other side. And what all of this forms is a really big cup. So then, you have the question mark, are we going to get the handle on that cup or not? Or are we just going to break the previous high with a new high and continue to the upside? One pattern leads into the next, right? One time framing or the flag pull, then the base and the range, then the run back on the other side. Now that we're through the half, we need to keep it. This is all of the Globex rather than drawing things the way that we would draw it for the 111. And you can see the halfback was the centerpiece of trouble. Now that we're through it, we need to keep it. So you have this halfback. Then you have the halfback of yesterday. And we're through both of those, so we need to keep them. The problem is we're moving a little fast here. We're causing a liquidity gap, and it's likely that we're going to see a retrace. But we got numbers coming, so let's get through that, and then we'll see what's next. All right, overnight volume just under 90,000. So we had a lot of participation last night. It'll be interesting to see when we get to the volume profile where that participation was at. Is it all in that base, or did the participation come in as we started to come out of that base last night? Or maybe it was at the open. Really like to see where all this volume came in at. The ADR is 90 points. It was in the 80s. It seems like it's beginning to expand again. It started to contract because we went sideways for a week and a half. We've reached the ADR half. If we get there early enough in the day, we can go to the other side by the end of the day. This is not about bullish and bearish. If we had reached the upper edge, we'd be saying the same thing about the lower edge. And this is just wave dynamics. This is what price does, right? We don't want price to move in a single line, in a single direction. We want it to do two-sided trading, a little bit for everybody. So now that we've hit one side and we did it really early in the day, we can get to the other side by the end of the day. And that would just be a part of the wave function. So not bullish by itself. 69.32 cog line. It's going to be a significant resistance level. To get there, we got to get through 6,900, which is a big round number. And the area that we've been fighting against, you can see the two areas that we've hit. We haven't been able to get through it so far. Maybe third time's a charm. My concern is 1, 2, 3 fail setup, especially when we rejected and set this low, and then we tried again and set a lower low. That's a dangerous precedent. Third time's a charm. 1, 2, 3 fail. If we come up and check that level again and can't get through, the next time we come down, it might not just be a reversal with a lower low. It might be a deeper move. So if we can get through yesterday's high, we've got the 111 and the 1236, and we've got the ADR half up there, which is really not much farther than the 1236. 8 points. What's 8 points among friends? And I didn't get that perfect anyways. 6 points. We could easily overshoot 6 points. So the base case argument for today is still that we maintain inside the ADR lines, either by doing what we did down here, where we escaped outside the ADRs but came back in. We could do the same thing on the top. And make no mistake about it, we can go from the bottom to the top, back to the bottom again in the same day. We've done it before, and we can do it again. It seems like a bit much, but it's doable. We haven't done a double before, going from top to bottom, back to top, back to bottom. Haven't seen that yet, but I'm sure it's possible. One thing we've learned over the years is price can do whatever the hell it wants. We're back above the weekly floor pivot. That puts us in a mildly bullish posture, but we're barely outside of the channel, so it's like sticking your toe across the line and then bringing it back again and, kind of flirting with the edge of the line in the sand. Until you've fully committed and crossed the line, then you're just sticking your toes across. So yeah, we're on the upside of the weekly pivot, but just barely. I mean, it barely counts. Hand grenades and horseshoes, but I'd want to see more commitment than that. The daily pivot, higher than yesterday's pivot, that's bullish. Price opened above it. That's also bullish. We cut through it, dropped cleanly beyond it. It's worth considering where those S&Rs are at. So we made it to S1 and beyond. Now we've come back up through S1 and we're back to the floor pivot. If we can get above that floor pivot and get outside the channel, then we can expand to the upside. R1 is at 23. That's really close to the 111, 1236 that we were looking at up there, right? The 123 was at 26. This is 23. That's really close, right? Close enough. So it just highlights again that we can go from S1 to R1, no problem. In the textbooks, they say S1, R2. R2 would be up here at 54. I don't see a path to R2 at this point. We'd need some news to kind of dispel some of this negativity, right? The warm, fuzzy feeling has kind of faded away. I think somebody needs their blankie. So maybe if they light a fire, drink some cocoa, they get warmed up, they can try again. Today's floor pivot channel is a little wide. It's not massive. You know, looking at it, it's close to the same size as the channel on the week. These channel ranges can be so narrow that it's almost no channel at all, right? Like it can get so narrow you just see a purple line. Kind of like how that one right there is how narrow that one is. There's what channel, right? So when it's at least as big as it is now, it's hard to imagine that this could be considered anything more than a wide channel. Wide channels imply that if we break out, it doesn't stick and we come back in again. Well, even to get that breakout, we'd have to get above 6,900, get through yesterday's high, and then actually get that breakout. That's a tall order all by itself. Just keep in mind that these channels and this floor pivot, it doesn't make price do anything. So we're not going to break out because of the channel. We won't fail to break out because of the channel. It's just giving us insight into, hey, if we did break out, are we expected to keep the breakout and continue to run, or are we expecting to fail to break out and come back in again? The wide channel says, yeah, if we break out, we'd probably come back in again. Good to know. All right, the distribution this week looks eerily similar to last week. This week's range is a little tighter, but other than that, this is very, very similar. We've got a narrower value area, and we're a little higher than last week, and our low is a little higher than last week. So higher high, higher low, higher point of control, higher second distribution, and a narrower value area. If I was to snap a Linreg line on it, it would still be pointed up and to the right. But we've had some drama, and the drop yesterday is a liquidity gap. So the concern is that we're going to make it back to 6,900 only to close the gap, and then we're going to fall right back down again. So we need to dispel that myth, right? We got to get there first and dispel it. We can see the same sort of situation happened back here when we had this swift liquidity drop. Mark that level. And you can see that when we did work our way back up there and we got back to that level, it immediately reversed. We didn't even set a candle there, right? We just set a wick, no body, and it dumped right back down again. Now, granted, we were still setting those higher lows, you know, so we came in and we also ended up setting a higher high and then another one, but the liquidity gap got closed right there. And that's the concern for today, right? That we could continue this run up only to get it to that level and then just face plant. Speaking of face plants and WWF wrestling, did you see Homeboy's got his last wrestling match? I think it's today, tomorrow, this week, and then that's it. He's done. If you know who I'm talking about, you know. And if you don't, well, don't worry about it. Probably don't care. I don't watch that stuff, but I got grandkids, you know, so 10-day, 30-minute volume profile and TPO. The distribution looks cleaner than we've seen it in a long time. This sideways mess over the last week or so, yeah, it hasn't been very, very fun, but it has certainly cleaned up the system. We've healed a lot and cleaned the structure up, not just here, but all over the place. This has been a much needed reprieve. So it's great, but it's time to move on. So GTFO, we expect to finally get out of this and do something else. If we don't set new lows underneath 6,800 today, then, or by the weekend, then when we get into Monday, we should have the narrowest range we've seen in a while. It's 100 points, 6,900 to 6,800, with a solid distribution and a center point of control, 6,850. Rare. It's been a long time since we had something so clean as this. So GTFO, short and sweet, right? 6,900 to the upside offers 7 and 7.5, and underneath 6,800, well, we go for 6,750 and then 6,650. As long as we're within the value area, we can cross back and forth through this point of control all we want. But once we get outside of that value area and we begin to expand, if we come back and check that point of control, we shouldn't be able to cross through it as easily as we could when we were inside the box. It'll start to act as support or resistance if we get too far away and then come back and check it. But as long as we're within the zone, we can just cross back and forth, no problem. All right, we're done with that VPOC from the other day. We didn't get a new one last night. And this morning, we've got just an absolute mess. All right, multiple distributions across the board. And now we're working our way through them on the way up. We've digested this one. It took a while. We're working on this one now. If we can get through that one, we've got another one up here, and then we're back to getting this gap closed. It's not much of a gap. I wouldn't get too hung up on it because that's not the gap we're worried about, right? We're worried about a liquidity gap, not a price gap. So these are just little speed bumps on the way up. We want to focus on that reversal right off of the round number 6,900, or give or take. Let's just tag that sucker. Wait. That one. All right. So if we can get through it, then 69.11 and we expand to 69.50, and then of course 70.50. All right, because we're running 50s. So you get above one, you got the next. But we got to get there first. We spent quite a bit of time digesting this last area before we could move on to the next one. We were able to move through this one relatively easy. We barely paused there at all. But now we got to get through this one. So level by level, let's work our way back up. If we begin to fail it and roll back over, we need to see that these structures are actually helping us on the other side, right? So if we do retrace back down into this 68.54 area, we want to see old resistance act as new support. This gray line is last Friday's close. So if you think about everything that we've done for the whole week since we closed on Friday, we're barely underneath that level. We passed through it in the last 12 hours. So we've done nothing for the whole week. Much like last week, until Friday of last week, we were dancing through the previous Friday's close every single day of the week. Even on Friday, now that I zoom in on it a little bit, every single day last week touched the previous Friday's close. So the precedent is set. We still need to get the heck out of this range. We're IX10 and we are NR4. Sounds really fancy and sophisticated. IX10 just means that we're inside day and it has lasted for more than 1 day. So that's easy enough, IX10. narrow range 4 in R4 just means the fourth day of being in a narrow range. Now, it's starting to expand a little bit. These wicks are getting a little deeper. That starts to create a megaphone pattern. But we want to, if it's a megaphone, it's supposed to expand on each side, right? That it goes something like that. Otherwise, what you end up with is a flat top or a flat bottom and expansion only on one side. And that's not a megaphone. We did pop through the previous high, so it's a little higher, but I guess, barely counts. Hand grenades and horseshoes. When it comes and we finally do leave this range, there will be no doubt. You won't have to ask. It'll be very clear and very obvious. All right, we're holding above the 10-day, 0.25%. I've got an imaginary box at a half, so 0.5% above, half below, and then 1% above, 1% below. Those are the two imaginary boxes that I tend to focus on. We're still inside the first box. So one, we're basically at the 50-yard line, right in the middle of the field. We could go either way. Two, there's no indication of any sort of concept of being overbought, oversold, overextended, moved too far, too fast. It doesn't owe us any mean reversion or pullback at all. Yesterday seemed like a big day, but one, we've retraced a lot of yesterday, and two, we haven't gone anywhere. So we've got the capacity to move 2% up or down, no problem. And we still wouldn't be overbought or oversold after a 2% move. We're wound up, fully loaded, ready to go with a full tank of gas. This market could make a good size move and still not be overbought or oversold. Looking at what's down this morning, Nat Gas, Bitcoin, the Mag 7 up volume, expanded tech, chips, tech again, China, lots more China. Banks are down, gold miners, quantum, and then we get too low on the list. Those are all the good things we would want to have for a rally day. On the one hand, that makes it really nice because they're a really good tell. If we need those to rally and they stop falling and start to run collectively, while the S&P is trying to break out and the VIX is falling, you've got the perfect signal to go long. We can run without any of those, but they would have to stop falling, right? They don't have to run, but they can't continue to fall and then have us run. If we're going to run without them, we're going to need some serious options flow or some radical news that would move us and not them. So it is possible, but more likely if we're going to get a breakout today, it will come on the back of them and options flow and headlines that collectively gets us that push to the upside. Otherwise, if they continue to expand to the downside, so can we. We're going to want to see the VIX break up, though, and continue that move to the upside for us to break down. We're going to need it because we're going to need the VC funds to start participating in the dump. Looking at what's up this morning, really nothing that meets our criteria of 0.5% except for the Mag 7 down volume and the VIX. So this is pretty simple. The VIX underneath 16, it's a good line in the sand. If we're going to start some breakdown and expand to the downside, we've got to get the VIX back up either through the 16 or if you've got your floor pivots on that 1633. If we get the VIX outside of its own range of yesterday, we're going to see a more fantastic move in the S&P and in the Qs to the downside. Otherwise, the VIX getting down to yesterday's low and then just staying down there, it doesn't have to fall lower, and it just needs to hang out there. We could be good enough to rally. It would be better if the VIX fell while we rallied. But at some point, if we had that dynamic, the VIX would go to zero and then it'd have to go under zero. And you know what I mean? Like if we're going to continue to go up, the VIX can't continue to fall. It's not like a teeter-totter, right? There has to be some slippage in there somewhere. So if it can get down around that 15.5 and just stop there, kind of hang out, digest, not do much else, then we could get a rally in the S&P and the NASDAQ. We don't want to see it turn around and start making its way back up. There was no hedging this morning, and we are moving in front of headlines. So the market does not care about the 8:30 data that's coming out, or they already have the data. They're not supposed to already have the data, but we know how that goes. So that leaves the 1 o'clock auction for today. Other than that, guys, keep your eye on the clock. Remember, there's a lot of other data points that come through on the day, and we don't know them all. You can't know them all. I promise. There's way too many economic events. But those economic events happen from government agencies, and government agencies are lazy. So half hour, new hour, maybe the quarter hour. Look for the dynamic to change, and we got to get outside of this range to do anything else. So GTFO. All right. Be careful, be safe. I'll see y'all tomorrow.